Welcome to Schneider Downs Wealth Management Advisors third quarter market commentary and recap. For those of you that don't know, my name is Jason Staley. I'm the Chief Investment Officer and partner here at the firm, and I'm joined by always my colleague on the investment side, Sean McCann. Back at it.
Happy to be here. Thank you.
Yeah, we had a really fun. I think fun for people that are investing in markets. Fun for people that believe in diversification. So it was. I think we have a lot to recap, and so kind of for those of you that are going to be watching this, the title of the commentary for the third quarter was "Global Central Banks Rally the Underloved and Underowned. Will the fourth quarter confirm a regime change in markets?" So, as the title would imply, markets really moved forward and had outstanding results in the third quarter, and it was among, I think, the asset classes that we least expected.
Yeah, I think it kind of talked a little bit to what we talked about last quarter, right? Talked to me after the All-Star break.
Yeah.
Are things going to be different from the first half, and now we're into the second half. And the third quarter kind of gave us a hint that things might look a little bit different than just the same old seven names going the same direction.
We talked about the third quarter being very pivotal in whether we were going to have a market that was going to broaden out, we were going to see, different kinds of leadership or just different kinds of styles and sectors catching a bid, right? And I think we saw that as we look at it. Or I think emerging markets up almost 17%. We're going to talk about what really fueled that and kind of the surprise announcement we got the last 2 weeks of September. Publicly listed real estate companies. Those two pop out at me as like kind of oh my goodness, kind of unexpected. But I think for client portfolios, the most meaningful were small caps and mid caps up over 9%. The equal weight S&P, and so that's where like our hometown PNC here in Pittsburgh would have the same weighting on January 1st of Amazon, Google, or Nvidia. So kind of more of a gauge of how well the broader large cap company universe is doing, not market cap weighted, was up 9.5%. Outperformed the S&P that was up a little bit under 6%, kind of 5.9%. So I think for our client portfolios, the small cap, mid cap, and this idea of a broadening out in large cap was probably the most impactful.
Yeah, and I think it doesn't necessarily mean, right, that when we talk about market breadth has really came back and the equal weight has outperformed the S&P and the Mag 7, doesn't mean that the Mag 7 are going away. Right. I mean, I think you talk about other sectors outperforming, right? Utility sector this year is one of the best performing sectors in the whole S&P. And that goes, I think, to say a little bit about we've still got AI. We're gonna need to power the AI. Where's that going to come from?
Exactly. What you saw was the impact of the Fed. Right. And we've been here saying that following an election, especially a close election, is always interesting for people that love political science. There's just a lot to dissect out there, especially in a country that's pretty kind of evenly divided, which is kind of creating ever closer elections. But we always felt like the chairman of the Fed was going to, and the Federal Reserve in general, was going to have a much bigger impact on capital markets this year. And we saw that, right? The Fed started to get some softer data on inflation, and they responded by signaling that we were going to get an interest rate cut. We got that 0.5%, so that 50 basis point cut in September. But markets are forward looking, and you saw that. I think small caps were up 10% at one point in July.
Right after that,
and you saw some movement along. But really, when you think about whether it's real estate, whether it's small caps and mid caps,
fixed income,
you're looking at the Barclays aggregate, so treasuries and agencies almost had the same return as the S&P. The exposure to interest rates, the more exposure you had or more sensitivity you had to interest rates, the better that you did because of the market anticipating that costs were going to fall. And I think when we look at small cap and mid cap companies, it's important to note that roughly 50% of small cap and mid cap stocks, their debt is floating rate.
Right, and so the lower interest rates is going to have a direct impact to their bottom line, right? As those interest payments get lower, and I know a lot of companies turned out their debt, but as those interest rates get lower, straight to the bottom line, they're going to perform a little bit better.
Straight to the bottom line, and they're different than the Magnificent Seven, who Apple was issuing a 50-year bond during COVID at like a 3% coupon or something. That bond is probably, the owners of that bond probably feel like they're going to get their money back, but you really saw that they benefited from that, right? They weren't as exposed to higher interest rate costs the way that small cap and mid cap companies, who for a lot of reasons, most of them very good, the investor base isn't going to loan a small cap company money for 50 years the way that they would Apple,
right?
Which makes sense. But I do think that kind of that broadening out was a good thing, and I think what we're going to see, and kind of as the letter would imply, do we see follow through? I mean, it's still TBD. I would say small cap and mid cap financials who have reported the first couple weeks have been broadly good, but a lot of their earnings kind of come later in the earnings season. We're kind of right in the middle of large caps. But the one thing that we have seen for the first couple weeks of October is that financials have done really well. I would say TBD on whether we're confirming the regime change, but you're starting to see some things like financials start to outperform. Let's transfer over, Sean, and let's talk a little bit about international and specifically, holy Lord, the emerging
markets, right?
I mean, the run that they had was pretty outstanding the last 2 weeks,
and it all came at the end, though.
It all came at the end. Maybe tell everybody kind of what really fueled that growth there.
Yeah, so really the story is all about China, right? And basically what happened is the People's Bank of China came out and provided this absolutely massive stimulus package that is hopefully going to spur some demand within that country. But, they're lowering interest rates, they're lowering mortgage payments, they're providing lending facilities so people could do stock buybacks, just a lot of different stimulus measures, which I think the market reacted, easy to say the market reacted quite positively. I think just China alone was up over, I think it's double digits just in that 1 week alone right after the announcement.
Yeah, I mean, I think you saw kind of the mainland Chinese stocks up like 30%.
Yeah.
They've given some of that back. The observers are saying, well, if they had announced that big of a stimulus, is there something kind of maybe underneath it? But
and there has to be follow through as well, right?
Yeah, but I think when you say PBOC, I mean, really we're talking about Xi Jinping, the premier. He is the person that runs China. Nothing happens in China without him approving it. And I think it's a market change from a couple of years ago where he was talking about how he wanted to grow from the middle out, and maybe was less worried about kind of the movements in the stock market. It seems to be a change. Obviously, when China stimulates, that's going to be largely should probably be good for emerging market stocks, but I do think a kind of lower interest rate environment globally is also good for risk assets and for emerging markets. International developed, we noted that, in the U.S., we've had this massive growth trade where growth has outperformed value. It's really kind of been the opposite in international markets where value is like kind of trounced growth for the last couple of years.
Yeah.
And you're starting to see, and I think some of that obviously has some things to do with China, right? But I do think that when you're seeing Roche and Novartis outperform, I do think kind of you have this value versus growth, which is interesting because you can make the argument that growth stocks, or more growth-oriented stocks in the international markets look cheap, and that's a diametric opposite to what we're seeing in the U.S., where we think value, small cap, mid cap look cheap relative to the mega cap 10. Wanted to briefly touch on fixed income. The Fed announced a 50 basis point cut. The European Central Bank had announced a cut in September, as did the Bank of England, Bank of Canada, and then the Bank of Japan. They're always mostly dovish. They're always mostly dovish. I mean, there are a lot of things that are going on with the Bank of Japan. But most global central banks, you'd make the argument, are kind of, the monetary policy is becoming much more accommodative, less restrictive, and they're announcing that the short-term interest rates are coming down.
Yeah.
And that had an effect, obviously, on fixed income, both munis and taxable bonds.
Yeah.
I think what that means for client portfolios is that the sock the money in short fixed income, ride out the interest rate volatility,
which has worked out really well.
Which has worked out phenomenally well, and we have been overweight in client portfolios, things like short-term securitized fixed income, and that's worked out. It has worked out really well, where you're taking advantage of some spread widening that happened during COVID, and then the pull to par on these shorter maturities. But now as we look forward, we're thinking the intermediate part of the curve looks maybe a little bit more attractive.
Yeah, I mean, we're going to expect, and the Federal Reserve has came out that we're going to expect more interest rate cuts coming in the future. Granted, it's going to be data dependent, so it might not be at the same pace at the whole time. But we would expect the rates on the front end of the curve to come down, but it doesn't necessarily mean that in the belly of the curve or in the intermediate part of the curve that rates are going to fall dramatically. And so I still think when we look at interest rates across the broad spectrum, we're still quite attractive today when we compare it to 5 years ago even. And so I think fixed income is still a part of the client portfolios, which still looks really, really attractive, even though spreads have come back in a little bit.
But I think that that there are going to be some changes that we're going to have to make and be nimble.
Yeah.
The Fed did put in the obligatory cautionary. That doesn't mean that we're going to continue to cut over and over again, but the trend at least appears to be that they're going to move kind of move the rates on the shorter end. Overall, the third quarter was phenomenal from a capital markets perspective. Very pleased. The broadening out, I think, for people that believe in diversified portfolios, that was really good to see. We still need to see follow through in this quarter. We need to see small cap and mid cap stocks, the earnings come through, right? You've got monetary policy, you've got some attractive valuations, but now you need to see earnings growth.
All right, we haven't achieved that soft landing just yet.
Yeah, the soft landing. So
yeah,
still a lot to take a look at. But before we wrap up, you'll notice that Sean is wearing a pink tie. I am wearing a pink bracelet that says courage, faith, strength, and hope. October is Breast Cancer Awareness Month. Obviously something that's really important to many people, specifically to this firm. And personally for me, my mom fought a 9.5-year battle with breast cancer, ultimately passing away in February on Valentine's Day of 2004. It's one of those things where if you take a minute, please check yourself, whether you're a man or a woman. There's a lot of, I think one of the more misunderstood things about breast cancer is that it only affects women. It also affects men too. It takes 2 minutes to do a self-check. If you have any questions or you're worried that maybe you felt something, go see a doctor. It can be the difference between living for another 40 years. So please do that from the bottom of our hearts for everybody that's in the fight with breast cancer, whether you're a patient, a survivor, or a member of a family who's going through it. Our hearts are thinking about you. We're praying for you. We've raised a lot of money for you. Darren Schindler, our shareholder on the tax side, was our Real Men Wear Pink for the American Cancer Society this year, raised over $30,000. I had the honor of being that in 2018 for the firm. So from the bottom of our hearts, please get yourself checked out. If you're a family that's in the fight, know that we are thinking about you and you're not alone. Until next time, Sean.
Always a pleasure.
Appreciate it.